Now the next presentation is by Mr. Sanjay Bembalkar, Co-Head Equity Union Mutual Fund. The topic of the presentation is How Will the Elephant Dance? Thank you so much, sir, Sanjay sir, for being here and gracing the occasion. Welcome to the event.
Yeah, good afternoon. Always a pleasure to present to Bangalore crowd. Always very happy, always being enthusiastic about finance. So very happy to be in Bangalore today. Thank you so much for this opportunity to AAFM. So let me talk about something which we did in February. In the month of February, we come out with first presentation on whether elephant will dance or what will happen, how can this elephant dance. And just one small clip from this presentation I will present, and then we'll shift to this new slide. Audio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So this is what we did in February, February this year, and we said that India is not only the large economy but also growing at a very fast clip. And when we presented this to our investors, team of Aarti, Varun, Ananya and Bhavani in Bangalore reached out to 450 plus distributors. Across India, we reached out to 3000 plus distributors, our partners. And when we presented this to our investors, some of the concerns which came through was that, okay, that's all right. India is looking very attractive from long-term perspective. But what about interest rates? But what about high crude prices? What about if again some geopolitical concern arises? What happens when in Fed rate cycle, what will happen to India? So at Union AMC, we have very focused approach on data. We are data driven in nature. So now already IMF has upgraded their forecast, and now we are not 6th but 5th largest economy in the world, and our growth continues to be above 6%. So we are 17th fastest economy in the world. What we have achieved in past 15 years, our GDP per capita, which has grown from $800 to approximately triple in last 15 years, that is expected to grow at a very high clip going ahead also. So there is much more room for us to grow in future as well. And these were the worries which were presented by the investors during this time. So we thought that let us go back, let us analyze what happens, what had happened in past actually when such kind of events have happened, when Fed rates increase, what happened to the market. So this is a historical analysis of returns with respect to Nifty 50 TRI index, and we tried to analyze what is long term for us, how investor can protect themselves, how they can tweak or how they can change their philosophy, mentality and get the better for what their investments are. So 2000 years back, the philosopher Seneca from Rome has talked about time heals what reason cannot. So he's saying that time, actually when you give time to something, that heals itself, which reason cannot, right? And this is what I'm trying to mention in this presentation. The time is your ally. In investment world, we are not only managing money, we are also managing the time of it, right? So we are arguing that time of these investments in the market is a crucial one rather than timing the market all the times. So look at this, when you invest, this is the data calculated from 1999 to 2023. So quite a sizable time of this data, how markets have gone through multiple cycles during this time, lot of events have happened. So negative returns when you invest, so for simplicity's sake what we have done is that at end of month, it is assumed that investors are doing STP at the end of month, and that is kept for the period which is mentioned at the top of the table. So one year is the time frame. 26% of the time investors have got negative returns in last 1999 to 2023. 0 to 8% returns 14%, and more than 8% returns 60% of the times. Now look at what happens to 2 years, 3 years, 4 years. So as you can see, the probability of negative returns historically has reduced, and potential to get better returns has increased. And now here we can conclude safely that why we always say 5 years is a long term. This table can actually tell you that why it is a long term from our perspective when we are managing public equity for retail investors. As time passes by, probability of higher returns has increased in past. This is a historical return, again just I am emphasizing because nobody should confuse it as to what I am trying to project. This is Nifty 50 TRI returns as such. Similarly, when you look at history, risk reward, so what kind of risk which you are taking and what kind of returns which you are making in that time frame. If you invest for 1 year, your minimum returns, what loss maximum happened was minimum returns which you got as an investor was 51.6%. The maximum returns were 97. So his short term is very volatile. This is what this table is indicating. Median returns were 13%, and standard deviation, the risk which you are taking was 26%. So we are calculating risk reward ratio as 0.5. So returns which you got for the risk which you are taking. And again this table is indicating that as time progresses, the bottom line, the risk reward ratio goes up from 0.5 to 0.8 to 0.9 to 1.2, 1.4 and 2.3. So again investors are better off holding on their investments from long term perspective, 5 years, 10 years, that is the time frame which we should be talking about. And we did this analysis as to what happened when US interest rate increased. So this was one of the questions which came to us, partners asked this question very prominently, that okay, India is going to grow fast, we agree with that, but what happens when interest rate across the world are increasing? And this is what has happened. There are 3 occasions in which interest rates have gone up. This table indicates that June 99, March 04, June 15, these are the time frames in which interest rates have been increasing from the Fed side. And this was the return made, again same calculation, month end STP for 1 year, 3 year, 5 year, 10 year, and this is the average return which one would have got, is 15%, minus 15, minus 8, plus 9 and plus 15. So again short term volatility is there, but as you go long term, returns are quite reasonable. So short term, as I said, is quite unpredictable. So in second period, obviously in short term also you have got good returns, but that needs to be kept in mind. Similarly, when RBI increased their repo rates, and that happened on 5 occasions. For first occasion, in 1 year you got 0% return, 3 years 25%, 5 year 32% and 10 year 20%. And this table indicates again that for 10-year period, 5 years and 10 years, numbers are reasonable. Short period, we obviously don't have control on what happens in short period. Too many variables change from public equity perspective. So we should be aware about it as a distributor, as an investment partners for our investors. This is the point which we have to clearly emphasize to our investors when they are making an investment. What happens when India's GDP slows down? So there are 3 periods where Indian GDP was at 5%, 2008, 2011 and 19. And again similar trend you can see that from short term it is unpredictable, but long term is quite stable. Say we are unlucky, and what happens that market crashes. And what had happened in past? So there are 4 such occasions: .com crash, GFC, which is Lehman Brothers crisis, demonetization, again black swan event happened, and COVID period. And you can see in the long period you tend to get a reasonable amounts of returns. But suppose you invested for 5 years, and what happens is that your exit happens when such kind of crisis happens. You had long term view, you invested very well. So for example, if GFC is happening in 2008 and you invested in 2003, right? So you are exiting and GFC or some another black swan event happens. What we are proposing, or what this data is indicating, that if you hold that investment for 6 months, just ask or push your investors that can you hold it for 6 more months, And this is the result of, this is a historical analysis of the returns, and this is what the returns would have been. So there would be substantial change in the returns which investor would have got. So as a public market player or as a mutual fund manufacturer, what we are proposing is this is what historically has been the trend. This doesn't obviously indicate anything about future or from the Union Mutual Fund side. So time heals everything. Why I am saying that? So this is the line of 1 year returns, and this is the variable or kind of volatility it had. If you look at 2 year CAGR, this is the kind of line. 3 year it is more stable, right? 5 year it is more stable. And I am today coining a new term here that this is the wealth creation line for us. If you want to create long-term wealth for your investors, this is the line which you have to focus on. Forget about volatility for 1 year or short term. When you are pitching a public equity product for your investors, I am urging you that you look at this kind of wealth generation over a period of time, and the line is quite stable. So the choice is ours, whether you want to take 1 year short-term volatility or you want to focus on long-term 5 years, 7 years, 10 years kind of investment horizon and get the wealth creation, optimal wealth creation for your investors. And this is what actually I wanted to convey a message. So attempting to time the market is thrilling. However, we are urging you that time in the market is important. Maintaining a long time horizon, particularly when you are looking at equity, that is at least 5 years plus, we should be looked at. Now you have data to back that as well. And for risk around inflation, interest rate, everything unnerving, black swan events, let the time heal what reason cannot. That is what Seneca said 2000 years back. That's what the first quote was. And that's where I will stop. Happy investing to all of you.
It was a wonderful presentation, and as elephant demonstrates power, I think I got very energetic when I saw that presentation. So thank you so much for showing that. It was really interesting. I hope you all agree, right? Thank you, sir, for the wonderful presentation.